Hi guys, welcome to Money by Sunny. When most people think of debt, they think of bills, high interest rates, and payments. But when it comes to money, the wealthy use debt as a powerful tool to make more of it. Of course, the main downside of debt is risk, as nothing in this life is a sure bet. So be warned, these methods aren't suitable for everyone, as the risks are there for the unprepared or uninformed. You certainly shouldn't go out and start employing these techniques willy-nilly without a whole lot of further education, research, and planning beforehand. However, used wisely and judiciously, debt can be a wealth multiplier. Here are 6 of the best ways that the rich use debt to make money. Number 6. Private equity. Private equity is the term for a type of investment company that invests in other companies, both public and private. The wealthy have been using private equity to make money for decades. Private equity firms are usually created by a single wealthy individual or a group of wealthy individuals. Because of their wealth, stature, and good relationships with lenders and other investors, they can then borrow money at a low interest rate and then use that money to buy a company that they have identified as undervalued or has good potential for growth. They then get to work on improving the company's performance, usually by putting in a new management team with the aim of increasing the company's value, so that they can later sell it for a large profit. Unfortunately, what is also sometimes done is cutting staff to reduce expenses to make the company more attractive. Definitely not the nicest thing in the world to do, but it is a common strategy. The company can either be sold to another buyer or floated on the stock exchange so that the investors can sell their stock and cash out. This is not an overnight process though, as growing the company's valuation sizably tends to take a number of years. But the use of debt in this way allows the wealthy to make a lot of profit without putting too much of their own money at risk. Number 5. Debt consolidation. Debt consolidation is often used as a way for the wealthy to manage their money smartly. By consolidating their debts into one lower interest loan, they can save money on interest payments and reduce the amount of time it will take them to ultimately pay off their debts. This then frees up cash that can be better used for investing and growing their money. In addition, debt consolidation is a time saver since there is only one loan to manage instead of many. However, debt consolidation isn't just for the wealthy. There are also advantages to debt consolidation even if you're not super rich. For example, the companies of business owners who have regular bank loans can often qualify for lower interest rate loans through government departments or agencies, which helps to lower the overall interest bill. This can help wealthy individuals to continue to grow their companies in a cost-effective way. Knowing how to take advantage of debt consolidation is essential if you're in business for yourself. Your personal finances and business finances are intertwined, so whatever money you save in one place will eventually come back to you. Although you shouldn't base your entire financial planning on the interest rate, you should consider what you can do to manage the interest rate in order to make the most of your money, just like the rich do. Number 4. Arbitrage. Arbitrage is the practice of taking advantage of a price difference between two or more markets. For example, if Company A is selling a product for $10 and Company B is looking to buy the same product for $12, there is an arbitrage opportunity. The wealthy can use debt to finance the purchase of products from Company A and sell the products to Company B. This allows them to make a profit without taking any risk, as long as they can lock in the purchase and sale through binding contracts or something similar. Now, selling 1 or even 100 of these products and making $2 of profit per unit will not do much to increase your wealth. However, once the wealthy identify a good arbitrage opportunity, they use debt to raise large sums of money so that their gains can be amplified. This is also called leverage or levering up an investment. This isn't limited to physical products either. One of the most common forms of arbitrage is buying and selling of securities, such as stocks, commodities, or forex, that trade on different markets or exchanges and have differences in prices. The price difference is often minuscule, and large sums of money are needed to make significant profits. And this is where debt comes in handy to the savvy, wealthy investor. Number 3. Buying assets that will generate a return. The rich use debt to buy assets that will generate a return that exceeds the cost of their debt. Done correctly, this will provide benefits in 2 ways. The first way is that the asset should generate regular income. For example, this can be done by buying a property that will produce income from rent, or by buying stocks or bonds that will produce periodic dividends or interest or coupon payments. This generates cash flow which helps to cover the interest cost of the debt, which keeps the investor cash flow positive. The second way is by the asset appreciating in value. One example of this is the property or stocks increasing in value over time. Of course, the investor could have just used their own cash to purchase these assets. However, the benefit of using debt is that the investor can use their current cash flow to continue to make other investments and focus on their day job, while the loan pays for the asset. Meanwhile, the asset continues to generate dividend or rental income, which covers the interest cost and grows its value. When the asset is fully paid off, the wealthy investor has all of their cash available to them and can choose to sell the asset or continue to earn the regular income from it. Number 2. Tax breaks and benefits. The wealthy often employ strategies that the average person may not be aware of. One of these is the ability to use debt in order to reduce their tax payable. This is because the interest on certain types of debt can be considered an expense which is tax deductible. In the U.S., this covers loans such as mortgages for investment properties, amongst other things. This means that the wealthy can borrow money to invest in assets that will generate positive returns, and then on top of that, classify the interest on those loans as tax-deductible expenses. This can be significant because the wealthy are often in the highest tax brackets, which can be 20+ or even 30+%. Being able to reduce their taxable income means that they are able to save this amount, which in turn reduces the tax and enhances their overall investment return on the asset. This strategy can be used to reduce the amount of tax payable on income, capital gains, and even inheritance. Sounds morbid, but the wealthy can also use this strategy to reduce their estate tax payable on death. Number 1. Short selling. When it comes to the stock market, or even other financial markets, such as commodities, we commonly think of buying low and selling high as the main way to make money. However, it is by no means the only way to make a profit. One method which you may have heard of is to use debt to short stocks and other securities. This involves borrowing shares of the stock or security, and then later returning it by obtaining the same share or security in the market. Common targets for short trades are securities that investors feel are overvalued and will eventually fall. If the stock or security does fall in price, the investor can buy it back at a lower price and give the shares back to the lender, profiting from the price difference. For example, a short seller may borrow a stock that is valued at $100, then buy it back when it later falls to $90, which means that they will make $10 on this short trade, less the cost or interest expense of borrowing the stock. Short trades can last for months or even years, or be as short as seconds or hours. Of course, if the security rises in price instead of falls, the investor will lose money. This is famously what happened to many hedge funds which shorted GameStop in 2021, and who then got burned by the army of retail investors who drove the price up. This forced the hedge funds to exit their short trades for massive losses. There you have it. I hope this video was an eye-opener and gives you a taste of how even a supposedly evil thing such as debt can be turned around by the wealthy and be used to increase their riches even more. If you like this video, please do subscribe and leave us a like or a comment. See you next time on Money by Sunny.